Chief Investment Officer at Alerus, and also Josh Ryder. He's our fixed income portfolio manager at Alerus. The two of them will be presenting on today's topic. Thank you again for joining, and Sunil.
Thanks, Mary. I hope you can all hear me clearly. Good afternoon to all of you. And I really want to thank all of you for joining us this afternoon. What I want to do today is talk a little bit about how COVID-19 is impacting the economy and financial markets. At its heart, COVID-19 is a human story. It's definitely a tragedy with over 1.3 million infected, over 75,000 dead, and the numbers climbing by the minute. But what I want to focus today on is how it impacts us in terms of our portfolios and the economy and financial markets. In order to do that, I just wanted to go back to find out how we got here, because there are some lessons to be learned as we proceed. So if I take you back to 2002, SARS, which is the severe acute respiratory syndrome virus, very similar to the coronavirus that we have today, originated in China in 2002. It was in the midst of the technology bubble explosion, so the recession was already well underway. And so it did not have as much of an impact on the stock market and the economy as COVID-19 is having today. But more importantly, it was not as contagious as COVID-19, and it was contained within 8 months. Also, the spread was primarily, even though the spread was in 26 countries, it was primarily in China, Hong Kong, Taiwan, Singapore, and Vietnam. The only Western country that was affected by SARS was Toronto. But what that did, it really gave these countries in Asia a lot of experience on how to manage this crisis. If you look at what's happened today with COVID-19, it's really the West, Europe, and the United States that have suffered because of their lack of experience and lack of preparedness. Just as an example, the Prime Minister of England is in the ICU, Prince Charles has been affected, and most of the infections and deaths are actually in countries like Italy, Spain, the United States, and other countries of Europe. So I think that this experience that these Asian countries had definitely prepared them better than the West. The other thing that happened is that because, if I just go back to the slide, because there were only few deaths and they were focused primarily in Asia, we developed a sense of denial and complacency in the West, in the United States and Europe. This is President Trump 2 weeks ago, and he's not unique. Many leaders in the West, and even today, the leader of Brazil, have not taken this seriously enough. Trump 2 weeks ago, I'm talking about the month of April, was calling it a Democrat hoax, and now, of course, he's much more serious, declared it a national emergency, and a lot of factors have been put into place to contain the virus. This has happened in many countries in Europe. What that did, though, it left us completely unprepared for the hospital care that's required and the testing that's required to bring this virus under control. Even today, we are not testing enough of our citizens to find out how widespread this virus is. We are certainly lacking in hospital beds, healthcare workers, personal protective equipment, and ventilators. And you've heard all these stories. So I think that what we have learned from this is that our hospital supply and equipment needs to be replenished. And so in order to do that, I'm sorry, I'm getting a sign here. We've put into place many measures such as social distancing, working from home, university and school closures, and cancellations of conferences, travel, sporting, and public events. This has been a coordinated effort to some extent between the public, companies which have gone out of their way, I believe, to help workers work from home, and then the government, which has, in some instances, mandated closures of universities and schools, but also public places, and public itself, social distancing from each other, and companies traveling, canceling conferences and travel. And this has been done primarily to reduce the rapid spread of this disease because we don't have sufficient hospital resources to take care of those who fall sick and those who die from this disease. But the economic effect of that, so it's truly a action done to control the spread to make sure that we have sufficient hospital resources to take care of the sick. But the downside of this is that we've entered a recession. We create a recession watch dashboard that we update regularly. And until February, this was flashing green. Now you can see in March, several factors have turned red, suggesting that we entered a recession in March, and we believe that this recession will extend through the end of June. Some of the factors that are flashing red for us are, particularly the jobless numbers. You might have heard we have, within a couple of weeks, have increased our jobless numbers by almost 10 million. Bond spreads have widened out, and financial conditions have tightened. And this is as a result of the government mandating a shutdown of most businesses, particularly the small businesses such as restaurants, travel, hotels, casinos, things like that. If I go to the next slide, you'll see that the part of the economy that's been affected the most is the consumer services economy. This is the travel, entertainment, restaurants, and retail. And if you follow from the right-hand side, you'll see on March 7th, you're starting to see the beginning of the slowdown. And as you come towards March 24th, toward the left-hand side, you see airlines, essentially nobody's traveling. Hotels, nobody's going to hotels. Cruises, you've heard about the cruises. People are canceling cruises. And also entertainment, such as sporting events, live action, either it's concerts, things like that, have been completely shut down. Restaurants, in-room dining is down, but people are going to curbside pickups and also delivery. If you go down, you'll see that the areas that are doing well are online electronics. This is essentially Netflix and games as kids are staying home and playing games online, and grocery as people have bought food, and that includes some general merchandise or toilet paper, things like that, which people have stocked up. But in general, this is a service-led recession, and consumer spending is almost 70% of our economy. So you can see the damage that it's doing to our economy, which is why President Trump and many leaders of the world want a partial reopening fairly soon. And we'll get to that in a minute. If you go to the next slide, you'll see that across the board, all asset classes are down, particularly the risk asset classes such as stocks are down across the board by about 20 to 30% in the first quarter of the year. What's held up well is bonds. You can see the green little tab up there, about 3% upside, which is why we continue to ask our clients to hold bonds, even though the yields are small or low, because they continue to hold up well during volatile period like this, particularly U.S. Treasuries. The red bar there is oil prices. You can see oil prices down almost 70%. Oil has been hit by two factors. One is the lack of demand, as nobody's traveling and everybody's staying home. So there's a glut of oil. But also because the relationship between Saudi Arabia and Russia is fractured. OPEC tried to make a deal with Russia to try and cut production, and the deal did not go through. So Saudi Arabia, to punish Russia, actually ended up increasing their production, adding to the glut. We believe that there are efforts going on right now to bring those two parties together. Plus, we've seen announcements from many of the oil companies to cut production this year. So we expect some of that demand, some of that glut to go away, but we don't expect a huge rise in oil prices. Because of that, we may not get a more significant drop in oil prices if the production cuts don't go into effect. So we have the recession, the stock market is down. I think the great thing that's happened so far is the response by the federal government and the Federal Reserve to this recession and to the downside of the stock market. Here you see a massive $2 trillion rescue package, and I call it more like a relief package that was passed by Congress. And it was passed in record time when you consider that, you know, this package was done literally in a couple of weeks versus 2008, 2009, and it took almost a year for them to pass a rescue package. The good thing about this package is that it's fairly large, it's 10% of GDP. It's expanded and extended. The employment benefits are extremely generous. They have expanded them and extended the time on them. There are direct payments to individuals and families. There's a lot of support to small business loans and grants, and we actually had a webinar just focused on that. There's also loans and guarantees to large businesses, aids to states to prevent state employees from losing their jobs, and to make sure that states continue to pay employees but also pay their bondholders. There's a lot of money for hospitals and disaster relief. So it's a relatively well-positioned program, and it's fairly large and broad, and it's done very fast. And so we think that what this will do, it'll definitely reduce the extent of the damage that's being caused to the economy. As people lose their jobs, they will have unemployment benefits that are sometimes even larger than their pay and lasting longer, plus support to all these small businesses, which is going to be required, and it's probably going to go up as many small businesses don't have enough money to tide them over or don't have access to capital markets like large businesses do. So we are very pleased with this program, and we think that should alleviate at least some of the pain that's being caused by this recession. The Federal Reserve has come out really strong and very fast to provide an array of supportive policies. At first, they cut the interest rates by 1.5%. This is the Fed funds rate that we all hear about. But beyond that, they've also cut a lot of other interest rates, such as excess reserves on banks, repurchase rates, things like that. But they have gone back to the playbook that they had in 2008 and 2009 and brought back many of those policies from that period, such as quantitative easing, where they buy treasury bonds and mortgage-backed securities on their balance sheets to control interest rates. And this is now unlimited, so they have no limits on how much they will buy. And they've also now decided to enter the corporate bond market, and Josh will touch upon that as to why they're doing that. They're buying bonds both in the primary and secondary markets because corporate bonds have been dislocated as people and funds and hedge funds and institutions have had to sell many of these securities in the market to generate liquidity, to generate cash. And so many of these markets have been dislocated. And the Federal Reserve has come in to ensure liquidity in these markets, not only in the corporate bond market, but also in the commercial paper market, in the money markets, and the municipal bond market. So the Federal Reserve has really gone out of its way to support the economy and to support many of these financial securities that have been dislocated by institutions and hedge funds forced to sell in order to raise cash to pay for redemptions or other factors. So those two factors, between the CARES Act and the monetary stimulus from the central bank, we feel will be very strong in preventing this recession, or what I would call a mandated slowdown of the economy, turning into a major financial crisis. And that makes us fairly hopeful for the future of this economy. With that, I'm going to turn the presentation over to Josh to talk about what's happened in the bond market.
Thank you, Sunil. Good afternoon, everyone. So we can see in this chart a chart of the U.S. Treasury yield curve on both January 1st and March 31st of this year. The U.S. Treasury yield curve is generally considered a good reflection of the general sentiment of financial markets. As we can see in this yield curve, it has transitioned to a lower yield across all maturities. The lighter green dotted line is as of January 1st, and the lower solid green line is as of March 31st. As we can see, at the front of the curve, some of the maturities dropped by nearly 1.5% or 150 basis points. And the 30-year dropped by over 1% or about 100 basis points, which was really astonishing. The U.S. Treasury sector was one of the first to react to COVID-19. It initially reacted by lowering yields and inverting the yield curve, both of which usually indicate a potential economic problem in the near future. As we can see from the chart, the front of the curve is now near zero, but it was actually negative for a time in the month of March. The curve is currently upwardly sloping, which is usually described as normalized, where we have the front of the yield curve or shorter rates being lower in yield than longer maturity bonds where they have higher yields. A normalized yield curve is usually indicative of the expectation of increasing interest rates in the future and a normalizing economy. So the chart, while it just looks like it was a simple drop in yields, did experience a lot of volatility between the beginning of the year and where it currently is today. If we go to the next chart, please. Thank you. This chart shows the yield spread between U.S. Treasury bonds and investment-grade corporate bonds over the last 12 months. As you can see, this chart clearly displays the disruption in the corporate bond sector. What happened was mutual funds and exchange-traded funds, otherwise known as ETFs, holding corporate bonds and other instruments, were turned into forced sellers. They had to shore up their cash and also meet redemption needs of their underlying investors. This same story played out in almost all non-government bond sectors, corporates, municipals, high yield, etc. The bonds were changing hands at dislocated prices, and it prompted a drop in the value of the securities and consequently a spike in the spreads relative to Treasury bonds. The forced sellers, including mutual funds and ETFs, were due to panic selling from the retail investors. And the sellers were met with reluctant buyers that required discounted prices to buy the bonds. In response to the liquidity crunch, the Federal Reserve announced new facilities to support and provide liquidity for both brand new issue and previously issued secondary corporate bonds. Also, the Fed has the authority for the first time ever to buy bond ETFs, exchange-traded funds, to provide further support for this market. Beyond the corporate bond sector, which we're looking at here, the Fed also expanded its quantitative easing to buy unlimited numbers or purchases of Treasury securities, agency-backed mortgages, otherwise known as MBS, and agency-backed commercial mortgage-backed securities. With time, this action will continue to stabilize non-Treasury bond sectors such as the investment-grade corporates we see here. As we can see in the chart, we've already seen significant healing, and we expect that to continue as the robust set of fiscal and monetary policy initiatives provide market support. This chart shows the ratio between AAA-rated municipal bonds, so the very highest quality, and Treasury yields over the last year. The municipal bond market experienced severe dislocation when a liquidity crunch similar to corporate bonds occurred which spiked tax-free yields. Municipal mutual funds and ETFs were also turned into forced sellers due to customer redemptions and panic selling. The rush of selling municipals was triggered by investors' desire for cash, as fears surrounding the spread of COVID-19 and the resulting negative economic consequences. This unexpected volatility left many investors stunned, and over at which the speed that it occurred was stunning as well. And then it was hard to digest at times the relative value it created in buying opportunities as bonds became dislocated. High yield munis funds were particularly hit hard as well. So this chart is AAA, but if you went down the quality spectrum to junk bonds in the muni market, they were hit even more hard with heavy investor redemptions. But even prices of the high quality bonds declined sharply, as we could see in that previous chart, as the funds were sold with all they could do to meet their liquidity needs. And again, the rush of selling was triggered by investors' demand for cash. But as you can see in the chart, as quickly as yields rose, they were also recovered. It was announced for the first time ever that the Fed, through special purpose vehicles, could buy longer-term munis in the primary and secondary markets. So as you can see from their peak, yields have already fallen by about 150 basis points, from over 350 down to 215 as of March 31st. And then if we could move to the final slide, Sunil. This table shows the market's implied probability of when they expect the Fed to change the rate on Fed funds. The markets are currently expecting no change to the Fed funds rate, indicating it will stay at zero for the foreseeable future. This is displayed in the implied rate column, which is at a little less than 2 basis points. It's 0.019. So the market's expecting no change. Recently, this has been a good indicator, and it has accurately predicted the Fed rate cuts that have happened recently. It is sensitive to new information and reacts accordingly, and we will continue to monitor the market sentiments. And with that, I'll turn it back to you, Sunil.
So the one thing I would add to the clients who are listening to our presentation is you might notice in your portfolios that some of the bonds might have lost value in the quarter. I ask you to pay attention to this, and that's because a lot of the dislocation is what's causing the bonds to lose value. We do hold very high quality bonds, and we expect that eventually with these Fed facilities and the fact that we own high quality, these bonds will return to the original prices. So I would not be concerned about those securities that you might see that have lost value. We just wanted to give you an explanation for that. So with that, I'm going to move to what I would say is the final piece of our presentation is to try to address how we move forward from here. It's clear that this has caused the economy to stop. It's also clear that people, cannot be infinitely staying at home and working from home. At some point, the economy needs to open up, and President Trump has talked about it. So I'll give you our views of what we think as to how this could happen. So this is a chart that's produced by Chris Murray. It's from an institute called Institute for Health Metrics Evaluation. And here you'll see the dotted line is what they are modeling as deaths per day. And in this chart, this is a little bit dated. You'll see that deaths per day go down significantly in June. And I think that's because of all the social distancing and the closures and all the activities that we've had so far. So I think if you look to what's happened in Singapore, Taiwan, China, they have achieved this almost about a month ago. If not, China has been even ahead of that. And they have slowly started to open up their economies as the deaths per day have gone down significantly. So the question is really how would that happen? Because the real issue is that once you open up the economy, you could get infected again, and so that's been the concern of most governments. So we looked at, how other countries are doing this and how it might happen in the United States. In this case, it would be fairly specific industries. So I think there'll be a lot of government guidelines to opening up the economy. That might be specific geographies that are not as dense, areas like North Dakota, South Dakota, geographies like that. People wearing masks, also specific industries that don't require a lot of social contact, so I don't expect travel and cruises to be opened up that quickly, but maybe factories that have a lot of robots and things like that, or banks where you could work with social distancing, or go to public places where you can have social distancing. So the idea is that now that in general, as the public is educated about this, about the hygiene aspect of it, about the social distancing aspect of it, that there is a way that we can learn to live and work with it, which will allow us to open the economy without causing the same kinds of healthcare impacts that we've seen in the past. But also, by the time the economy opens up, a lot of the healthcare issues, some of them at least, will be resolved in terms of ventilators, masks, equipment, things like that. So even if some people get sick, the hospital will not be overrun. To do that, though, I think one of the things that the West has lacked is extensive testing. We need to make sure that everybody is tested, basically. And there are two kinds of tests. One is the viral test, which tells you whether you have the virus or not. And then the second one, which I think is being, it's already developed but needs to come out and expanded, is called a serological test, which essentially tests whether you have immunity. So if you get the virus and you survive and you come back, you generally have immunity, but people need to be tested. One of the issues that people have is that because testing has not been so expansive, we don't know how many people have immunity, because there might be a lot of people who caught the virus, have very, very mild symptoms, never even went to the hospital, and may have developed immunity. But to learn whether if that's actually a fact, you need to have the serological testing going. So I think that will help a lot in terms of opening the economy. The other thing that's really helped Taiwan and Singapore and other countries like China is a national surveillance system. So so once you bring the death count down and open the economy, if you have a lot of testing and there is early detection and surveillance, and this leads into a little bit of a privacy issue, so that makes it a little tricky. But this is what they have done: is they have smartphone apps and other apps that provides a signal as to whether you have a symptom, and then you can be quarantined or isolated. And there's a tracing system that traces all the people that you've come into contact with and made sure that they are aware of this, and some of them may be isolated too. So this is a sort of a way that's worked, and I think this is something that we might see in the second half as the death count goes down. The next thing, the more important issue is therapeutics. I mean, if we develop therapeutics, which essentially what they do is they reduce the symptoms and reverse the symptoms. So if you got coronavirus and you are generally healthy, or even if you're sick, some of these, the idea is that these therapeutics will reverse the impact of this virus and treat you and bring you back to normal, or maybe not make you as sick, and certainly a lot fewer people will die. And so I'm sure that you heard of, there are some existing therapeutics, hydroxychloroquine, which Trump talks about a lot. This has been tried in different countries and with different results. It's being tested right now. So we should start to see whether this actually works. And when I say work, it means not just, giving it needs to be given to a large range of patients to understand how much, what the dose should be, who should be given, how frequently does it work, does it have any side effects. So it's a fairly extensive thing. And so we'll start to see some early results by the end of April and May. There's also a drug called remdesivir from Gilead that has been used in other areas such as Ebola, Gavzara from Regeneron, and then convalescent plasma, that you might have heard of this too, where they take antibodies or plasma from people who have contracted the virus and then use that to inject patients who are becoming sick to create antibodies within the person so that that will defend against the virus. Some of these results will start to arrive in April. And I would say that if any of these show promise, the economy opens up much quicker than simply the previous slide I showed. So I think we are anxiously waiting for these results, which should appear by the end of this month or early next month. If these don't work, there are also companies like Regeneron and Vir Biotechnology that are working on antibody drugs. So if you think about the plasma therapy, which is essentially taking antibodies from somebody who has contracted this disease and injecting them, that's not necessarily a scalable solution. What the antibody drug does is that it creates a synthetic antibody very similar to what you might get from the plasma and inject that into people who have contracted the virus, and hopefully that reverses the disease, cures people, fewer people die, sick people get better sooner. So this has to be a huge way to open up the economy faster. The antibody drugs will take a little bit of time. We don't expect trials to happen this summer. Obviously, if the existing drugs work, that would be ideal, but we'll find out in May whether that's going to happen. And finally, we need to have vaccines. So ultimately, just like we do for the flu, we are going to have to take a vaccine, as this would be a recurring virus. A vaccine would be an injection that would have to be done globally because this virus is basically infecting all countries. There are a lot of companies that are trying to develop a vaccine, and there are a lot of companies that are trying to develop therapeutics. As you can imagine, the scale of this problem is so huge that everybody that can develop a vaccine or a drug is working on it. So we feel good that the attention to cure this disease or to create vaccines so that you never contract it in the first place are in place. The leader in this is a company called Moderna. It's a biotechnology firm based in Massachusetts. We expect phase 1 trials to start in March. Actually, they did start in March. We expect results in summer. And they feel that they could, if this works, they could have small doses of this vaccine available in the fall of 2020. This will be first given to healthcare workers who are really the frontline warriors against this virus, and a large-scale production that could go to millions or billions of people is likely to be happening in fall of 2021. So that's the general timeline. You might have also read of Johnson & Johnson. They expect human trials to begin in September and 1 billion doses by the end of 2021. There's another company called Envio Pharmaceuticals that is a little bit later. But there are a lot of companies that are after a vaccine, and we expect some success to show up this summer, which will give us a lot of confidence as to the timeline that is going to take place for us to come out of this. So with this, I just wanted to quickly touch upon some of the portfolio changes that we've been making given the declines that we've seen in the market. First and foremost, we've rebalanced the portfolios and optimized them as bonds have risen in value and stocks have come down. This has given us opportunity to buy stocks from the bond side and rebalance the portfolios. We've also taken the opportunity to harvest tax losses, which we do in our tax-sensitive portfolios. Within the equity portfolio, we are taking an approach that this is going to take a little bit given the development of the drugs and the vaccines. So we are moving to higher quality companies with secular advantages. We've also divested our positions in any company that could be disproportionately hurt by COVID-19, companies such as travel-related, entertainment-related companies, which might take a lot longer to come back. And we've also added exposure to companies that are involved in therapeutics and diagnostic solutions. On the bond side, we've invested the excess cash. We invested the excess cash ahead of this falling yield scenario and extended duration to protect our clients against this virus. So these are some of the changes that we made to help you not only protect your portfolios against the virus, but also position them over the next couple of years. So with that, I'll come finally to our outlook. Our economic outlook, we believe this is going to be somewhat of a U-shaped recovery. Unless we get an existing therapeutic that works, and we'll find out in April and May, we think that the first quarter is a recession. The second quarter is a significant recession, as you can see, almost down 25%. The third quarter shows an upside of 14, but that's on very, very low levels. You have an economy that's gone down 25% in the second quarter from the first. So it's a 14% seems like a lot, but it's really not. And it could be even less than that if it takes a long time for the economy to open up. So our base case scenario is that we probably see a U-shaped recovery as governments and people and companies start to get more and more comfortable with opening up the economy without a therapeutic or without a vaccine. And then in 2021, as you can see, our annual GDP forecast, you can see a 5% jump. We think that by that time, there'll be some drug or some therapeutic out there, plus people will have figured out how to work within the virus, constraints of the virus. And there's a lot of pent-up demand in the economy as people are not going out, people are not spending money. So we think that people will spend a lot more and the economy could have a robust recovery in 2021. So this is our general outlook today. It keeps changing a lot because this is a fairly uncertain scenario. We have not, and nobody has faced a virus like this, and it may or may not conform to what we think should happen. So a lot of this is very dynamic and could change very fast depending on how quickly the drugs are developed and how quickly a vaccine is developed. And finally, I wanted to give you our market outlook. So as I've been saying so far, our base case is that the economy begins to slowly open up in the second half. We start to see therapeutics available by the end of the year. I'm assuming here that really we probably need an antibody clinical approach rather than some of those existing ones. If the existing ones happen quickly, that's the optimistic scenario. But if we get a new drug that needs to be developed, it probably happens by the end of the year. The vaccine becomes available in the fall of 2021. And we think that the S&P 500, takes about 2 years or longer to retrace back to its high of February of this year. In general, when you have a deep recession, it takes about 3 years for the S&P 500 to retrace its previous high. This time could be sooner, as we've had a very sharp downturn, and we can get a very sharp upturn should we get some of these drugs and vaccines sooner. But our base case is that we probably see that in 2021. The optimistic scenario is the one where we see the existing drugs working, we see a vaccine come on very soon. Bill Gates has talked about developing production capacity for all the 7 vaccines that are in trial, and maybe he does that, and we have a vaccine available early next spring, and things come to a head very fast, and the S&P 500 retraces its previous high as early as 2021. The pessimistic scenario is that the economy opens up, but it opens up and a lot of hotspots develop and people shut it down again. The drugs and vaccines are delayed, and then you're starting to see 2023 or something like that for the market to get back to its previous highs. So that's where we stand today. And with that, I'm going to pass it on to Mary to see if there are any questions.
Yes, thank you, Sunil. Much appreciated. Wealth of information. And we do have a few questions that have come in from the Q&A that I wanted to ask. So Anne had a question. If the economic outlook doesn't look great, why don't we just pull out of the market and reinvest when it looks better?
Yeah, so I think that as I said we have 3 scenarios, and it's very likely that we could get the optimistic scenario, the things could come back much sooner than we are anticipating. So it's very difficult to time that, and you could time it just at the wrong time, get out of the market, and then if things change, it might be very hard to get back in time. So we don't really recommend that. We also, one of the things that I do want to say is that, when you're investing in the equity market, you really should have a very long-term horizon. And when I say that, it's 5, 10, or even longer. Equities generally have duration of 30 years. And, we get very excited about what's going to happen this year or this quarter. It really should not be that way. You should be thinking about it long-term. And in fact, you should be taking advantage of any declines that happen this year to position yourself for the gains that will happen eventually. As I said, there's so many companies and so many scientists around the world that are cooperating on this effort that, we are going to see, I remain hopeful, let me say that we're going to see some exciting therapies and vaccines that are coming out of this that not only help us get out of the situation, but also all the learning that we've done, prepares us for a virus impact that's definitely going to happen again.
Thank you, Sunil. Much appreciated. Another question came in from Ryan. He asked, how should long-term investors look at this event?
Yeah, I think as I said earlier in my answer, it's the same. Long-term investors should look at it as an opportunity to add to their equity portfolios, just like what we've been doing. We've been taking advantage of the increase in bond values, selling them, and buying stocks. And if stocks go down, we'll do it again. Because as I said, we have a very long-term horizon for our clients, and clients should have the same. I think this bear markets generally tend to give you an opportunity to buy more of cash flows that are valued much cheaper than they were just a couple of months ago.
Great, thank you, Sunil. A question came in from John. How about retirees who are typically focused on cash flow? How do they think about this?
Yeah, so I think for retirees, the way we have designed our solutions for retirees is that we have a portfolio called the Income Builder, which actually has a fairly high dividend yield along with a high income from corporate bonds. So the way we think about it is that between that portfolio and Social Security and other areas of pension, you should have sufficient income to tide you through this event. I would ask you to see if there are ways to cut down a little bit before you sell anything right now. If you are going to sell anything, I would sell something that's fairly liquid, certainly not on the equity side if you can. As I said, if you just have to make sure that if you can get by on the cash flow without selling securities, that's the ideal solution. But if you need to sell to get cash for your day-to-day life, please call our advisors, and we can recommend that on a case-by-case basis.
Thank you, Sunil. A question from Brian. What thoughts would you have for those with cash on the sidelines that we want to put to work?
Yes, I think that if you have cash on the sidelines, this is a good opportunity. I would be dollar cost averaging into the market rather than lump summing right now. If we get another sharp sell-off potentially in the summer because some of these drugs don't work or something like that, and you wanted to do a more lump sum entry into the market, that might be an opportunity, but that's speculation on my part. I would take an opportunity right now to dollar cost average into this market over the next 12 months.
Great, thank you, Sunil. A question from Joe. Can you comment for our clients that rely on stock dividends for income, what we could expect for dividend cuts in a better case or not so good case?
Yeah, so I think I would say that the way we have approached the dividend portfolio is that we have bought very high quality companies that we believe have sufficient liquidity to withstand this event. With that I mean is we look at their cash flows in terms of their ability to pay interest on their loans, but they also have, if they have share buybacks or they have capital expenditures, they generally tend to reduce those first and reduce employees first before they cut their dividends. Having said that, there are one or two companies that we have eliminated from their portfolios. We used to own a company called Las Vegas Sands. It's a casino. We think that that's going to be one of the type of entertainment type of companies that might take a little longer for them to come back to normal. So those are the kinds of companies that we have eliminated. We've also pruned our portfolios in some of the cases because, for example, in the energy area where oil prices have gone down very hard, some of the dividend yields are very high. And when I say very high, they're around 8 and 9%. So in that case, even if the company cuts the dividend, the stock price is already reflecting that. And so I wouldn't worry about it in that sense. But all those companies that we have are very high quality companies that we believe will withstand this downturn.
Great, thank you, Sunil. A question from Kathleen. Please explain what happened to individual bonds in the last year.
So I would turn this question to Josh, maybe, if you want to take that, and I can add value after he answers that.
Yeah, certainly. So I think we have a case of differences depending on which sector in bonds. I mean, on a whole, the U.S. aggregate, which is a basket of both government-backed and non-government-backed, for 2019, it actually had a very strong return of 8.7%. And then in the first quarter as a whole, the U.S. aggregate returned about 3.1%. So a positive return in both situations. And if you look at government-backed securities, they actually did very well in the first quarter. But on the other hand, we saw that investment-grade corporate bonds and U.S. high yield and emerging market debt did very poorly in the first quarter as people were selling riskier bonds and moving towards more high-quality bonds that offered more liquidity, such as U.S. Treasuries. For the month of March specifically, again, it was a case of Treasuries did very well relative to high yield, which did very poorly. So it depends which asset class you're in. That kind of tells the story as to what happened. Higher quality, the better you did, and the lower quality, the more you suffered the consequences of investors panic selling.
If I could add a comment there, if you definitely need cash for your day-to-day living, please call your advisor, because what that does, if they ask us to raise cash, we can then raise it from the appropriate asset class that makes the most sense. For example, in this scenario, we probably would end up selling some treasuries, which have appreciated a lot in value, and not necessarily securities that have gone down in value. So I would recommend that you call your advisor, and then they will put in a request to raise cash with us.
Fantastic. Thank you, Josh, and thank you, Sunil. A question from Terry that I received. The CARES Act provides $600 per week for unemployment recipients. Will this cause problems for small business to bring back the workforce, since most will receive more than 100% of their paycheck?
Yeah, that's an excellent question. The Congress has really tilted this rescue package towards workers and less towards businesses. So I do think that there might be situations where some workers might leave because they might actually make more by leaving their jobs than staying in their jobs. But I do think that when this turns around, I think there'll be a scramble back into the job market because these are finite benefits, and I think it's not in the interest of the employee to be necessarily, giving up their jobs for 3 to 4 months if this thing turns around very quickly. But it certainly is possible that some of the small businesses might lose employees here. I do think that, and I'm not an expert in the PPP program, as they call it, to support small businesses, but there is a granting type of approach where if they maintain a certain level of payroll or certain level of employees, then those loans to small businesses become grants, and they don't have to repay the loans. So there is a lot of incentive for the small business people to retain their employees should they approach the SBA with a loan.
Great. Thank you so much, Sunil. This next question is for Josh. Sandy had a question, Josh, we were hoping you could answer. Could you comment on the likelihood of bond defaults? How does this impact decision that Alerus makes?
Yeah, thank you for the question. That's a good question. So here at Alerus, we tend to focus on very high quality bonds when we buy individual bonds. If it's an investment grade corporate bond, we stay within a 10 years generally from maturity. And we're also exclusively investment grade, buying large companies that usually have, not always, but sometimes pay a dividend as well to their common stockholders. So usually investment grade companies, especially U.S. domestic companies, have a lot of levers they can pull prior to defaulting on their corporate debt. They can cut their dividend, they can cut their preferred stockholders, they can issue more equity. I mean, if they turn to the bond holders, that's kind of the area of last resort before they've concluded all other options. And the reason I'm speaking about corporates first is that is probably the area of highest risk for default, albeit it's very, very low. The municipal bonds that we buy at Alerus are predominantly very high quality, AA or higher, and they're generally essential service. So usually they're backed by water or sewer revenue or electricity, or their general obligation, meaning that the underlying property taxes would be used to pay for those bonds. So the default risk even now is very low unless we go into a very, very extended recession or depression where these local governments just run out of funding because the underlying taxpayers can no longer pay their property taxes or can no longer afford electricity or to heat their homes. So in both situations, it's a very long horizon before we wander into a situation where we're concerned about default. And then the balance of the portfolio is government-backed. So there the risk is zero, if not extraordinarily minimal, because they're government-backed by the U.S. Government. Especially in the case of our mortgages that we buy in our portfolios, the default risk would be covered by the U.S. government.
I would add that the CARES Act provides states with a lot of funding to support the municipal bond area and support the employees, the state employees to stay employed. So all that is going to affect, even in the 08-09 recession, the amount of defaults in municipal bonds was extremely low.
Great. Thank you, Josh, and thank you, Sunil. At this time, I believe we have answered the questions that have come in through the Q&A. So much appreciated for you taking the time to do that. Sunil, before I wrap up, do you have any final comments that you would like to add?
No, I wanted to thank all of you, and I hope you found this useful. If you have any questions, please call your advisor, and we'll be happy to answer them even after this call.
Great, thank you, Sunil. Actually, we had one more question. I think we do have time. Let me sneak this one in very quickly for you, Sunil. This question is a follow-up one from Terry. For the grants to occur, a small business needs to spend at least 75% of the loan on employee wages for an 8-week period once the loan is provided. If the small business cannot bring the employees back due to high unemployment comp, then it becomes a loan and not a grant. So the employment issues, getting employees to work, is short-term based on the CARES Act. Do you have a comment for that?
Unfortunately, I'm not an expert on that subject, but we do have experts on that subject, Mary. I think that we had a seminar on that or a webinar that you hosted, so I would refer to them rather than me.
Thank you, Sunil. We'll follow up and provide that information. At this time, I do want to thank everyone for joining our session today. I want to thank Sunil and Josh for their efforts in presenting all of this information. As I mentioned at the beginning of the session, we will be sending a copy of the presentation materials as well as the recording of this session out to everyone. It may take a day or two to get that out to you, so please look for that. If you do have additional questions, as Sunil mentioned, I'd encourage you to reach out to your Alerus advisor or our Client Service Center. And you can find more information about the COVID-19 on our website, alerus.com. Again, thank you so much for joining, and everyone have a great afternoon. Bye now.